Unit 5. Using relevant applications in practice, posting of the most common events in a company private entity. In this part unit, the relevant practices in the posting of business events are explained by using practical examples. The practical examples provide a clear and easy understanding of the process of registering business changes in the company. In order to present the relevant practices in the posting of business changes, each posting contains an explanation that gives the reader an additional insight into the matter. After reading this unit, you will be able to read and present practical examples related to the posting of business changes. The Accounting Act prescribes the obligation to keep books according to the rule of double-entry bookkeeping. The proper posting of data must meet the following criteria. Algebra HR. It is based on an appropriate document. Data entered is in the Slovenian language. Data are entered in a continuous sequence without leaving a free space. No possibility to delete and change the original text and the amount. Posting of data immediately upon the occurrence of a business event, depending on the time of arrival of a document for bookkeeping. Respecting the principle of an unchangeable record. We are continuing with examples based on the most important economic categories. An intangible asset is an identifiable non-monetary asset that normally does not exist physically. As a rule, it is an intangible long-term asset. Intangible assets with an individual value of not more than €500 may be considered as costs in the period during which they are acquired. Intangible fixed assets are only those intangible long-term assets that co-create business facilities and are not just items of long-term accruals, patents, licenses, trademarks, etc. For the recognition of an individual asset as an intangible asset, two conditions must be fulfilled, and for certain groups of intangible assets certain criteria are also prescribed. According to Slovenian Accounting Standard No. 2, intangible assets are investments in acquired long-term industrial property rights and other rights, property rights, long-term deferred development costs, capitalized costs of investments in foreign tangible fixed assets and investments in the name of the acquiree. If we accept one of many definitions of intangible assets that defines it as being non-physical, intangible, and identifiable, it cannot be expected that a person who has not dealt in depth with the analysis or is not professionally involved in financial accounting activities can understand what can and should be deemed as an intangible asset. From the accounting aspect, intangible assets are defined by the Slovenian Accounting Standard No. 2 and International Accounting Standard No. 38. These standards require the ability to identify assets and to control over them. The identification of an intangible asset implies its authenticity, which results from the possibility of separate sales, transfer, licensing, leasing or exchange. Also, the control over the means implies the possibility of realizing of the future economic benefit that needs to flow from the use of the means. The most common examples of assets classified as intangible, according to the above-mentioned standards, are computer software, publishing rights, development expenditures, brands, know-how, goodwill, patents, licenses, concessions, trademarks and similar rights, franchises, licenses, marketing rights, design, etc. Intangible assets can be internally developed within the company, but according to the provisions of the above-mentioned standards, the research phase and the development phase need to be distinguished. The expenses incurred in the research phase cannot be capitalized, attributed to the value of the intangible asset, but should be treated as costs incurred in a specific period. In the development phase, in order to attribute the costs incurred to the assets, the technical feasibility of the intangible asset to be completed must be proven, so that it is available for use or sale, as well as the intent of the entity to complete the intangible asset, the availability of appropriate sources for the completion of the development phase, the possibility of the use or sale of assets, the possibility of reliable measurement of the costs incurred which are attributed to the intangible assets during the development. The depreciation of intangible assets is mainly depreciation only reduces the carrying amount of an intangible asset with a finite useful life. Depreciation begins when an intangible asset with a useful life is available for use. Depreciable amount of an intangible asset with a finite useful life shall be allocated to the best estimated useful life of the asset. An intangible asset with a finite useful life is amortized over the useful life. Depreciation method used reflects the pattern of the emergence of economic benefits from an intangible asset with a finite useful life. If the sample cannot be reliably determined, the straight-line depreciation method is used. Depreciation charged for each accounting period is recognized as the expense or operating expense of that period. The age and method of depreciation should be reviewed at least at the end of each financial year. If the expected useful life of an intangible asset with a finite useful life differs significantly from the previous estimate, the amortization period should be modified accordingly. If the expected pattern of the emergence of economic benefits from the asset changes significantly, the depreciation method should be modified accordingly. Such changes should be seen as changes in accounting estimates. They affect the calculated amortization for the accounting period in question and for the subsequent accounting periods. The residual value of an intangible asset should be checked at least at the end of each financial year. The residual value of an intangible asset with a finite useful life does not exist unless the following exists. The obligation of the other party to purchase such an asset at the end of its useful life, or the asset is an active market, and the residual value can be determined taking into account such a market, whereby it is likely that such a market will exist at the end of the useful life of the asset. Goodwill and an intangible asset with an indefinite useful life are not depreciated but are revalued due to impairment. Here you can see an example of movements of intangible assets, which are presented in accounting for T accounts. The example shows the purchase of the software license and the value of the VAT account at a general rate. The correct net value and the value of VAT, 22%, must be calculated before accounting. Example: the value of the purchased license per account amounts to €2,000, which is shown as an increase in liabilities to the supplier on the passive side. The active side covers the purchase price of the fixed asset in the amount of €1,640 and the liability for VAT at the general rate amounts to €360. It is important that a company has defined in the accounting rules what is classified as fixed assets, what is included in small tools, and what is the cost of the material. It depends on whether the company can charge depreciation, which is a tax-recognized expense of the company, and whether the individual cost in the current business year is considered a tax-recognized expense. These questions ultimately affect the net profit of the company. Fixed assets comprise tangible and intangible fixed assets and long-term financial investments. Tangible fixed assets are assets held or financial leasing that will be used for several years. Tangible fixed assets include, for example, land, buildings, equipment, multi-annual plantations, stock of investment material, intended for incorporation into other items of fixed assets, etc. Tangible fixed assets are defined by SAS 1 and IAS 16. A tangible fixed asset, the individual purchase value of which, according to the supplier's invoice, does not exceed €500, may be shown collectively as a small tool or as a fixed asset. However, care must be taken not to post a specific asset, for example a computer, both as part of the assets and the inventory. In the event that doubts arise when purchasing a fixed asset, we define the asset in accordance with its content. If the fixed asset is used to carry out our core business activity and will be used for more than 1 year, it should be defined as a fixed asset, for example a computer with a value of €400. It is important to depreciate fixed assets. Small inventory or tools, the individual purchase value of which, according to the supplier's invoice, does not exceed the value of €100, may be classified as small items of inventory or as material. The same rules as for fixed assets also apply to the classification of fine inventory and material. These are assets held or financial leases used in the creation of products and revenues and are used for more than one accounting period, business year. When we spend these funds, we are talking about the emergence of a cost that we call depreciation. This is therefore the cost that shows us the wear and tear of the fixed asset and its real value. We must know that the fundamental rule of books is to show the real state of the enterprise and its value. Some assets are not depreciated. These are lands or buildings under the monument protection, which cannot be limited in time. The depreciation rate in percent is determined by dividing the number 100 by the number of years of use of the fixed asset. The accounting policy determines the orientation, according to which depreciation rate, the amortization will be calculated for a particular group of fixed assets. Depreciation means an expense which is not an outflow of money, but accumulation for the acquisition of a new fixed asset when it is exhausted. Subsequent investments in tangible fixed assets that are not the nature of maintenance work always increase the value of the property and reduce the value adjustment, and are not direct expenses of that year, neither do they reduce the direct tax base. Investment property, which is also depreciated, is intended solely for leasing. Depreciation is defined in the Slovene Accounting Standard, SRS, as an amount that leaves the depreciable asset in the individual accounting period and represents the current cost. Depreciable assets are those that are used in a period longer than the financial year, have a limited useful life, and are intended for use in the production or supply of goods and services, are lent to others for consideration or are held for other reasons. The Corporate Income Tax Act, ZEDPO2, recognizes the depreciation of tangible fixed assets, intangible assets and investment property as an expense. Only the straight-line depreciation method and the following annual maximum depreciation rates are permitted. For construction works, including investment property, 3%. For parts of construction works, including parts of investment property, 6%. For equipment, vehicles and machinery, 20%. For parts of equipment and equipment for research activities, 33.3%. For computer, hardware and software, equipment, 50%. For multi-annual plantations, 10%. For rearing herd, 20%. For other investments, 10%. Following is a business example of movements of tangible assets which are presented in accounting for T accounts. The simple principles of accounting on T accounts are always the same: an obligation to the supplier, which represents the gross value of the account as a passive side, and an active side that contains the VAT input and assets. Example: the company seeks a loan from the bank for the purchase of funds in the amount of €500,000. The long-term or short-term financial liability to the bank is increased in the balance sheet. Funds are directly paid to the supplier, so the simultaneous obligation to the supplier of €500,000 is established and also closed. The net value of €410,000 without VAT is shown as an increase in the asset side of the assets and the setting up of a receivable for the company's debt of €90,000 at the general rate. Short-term assets are usually transformed over a period of time that is shorter than 1 year. They consist of assets for sale, supplies, material, packaging, merchandise, finished products. Short-term operating receivables, to customers, receivables for input VAT. Short-term financial investments, loans granted. Cash on a bank account, cash stock. Short-term deferred costs, example, insurance paid once a year, and at the expense of the monthly premium, since the entire premium is paid in advance and it does not represent the cost of the month in which we paid it. Money. Doing business is possible under the condition that an entrepreneur opens a business account at one or more banks. It is a bank account through which he will be making all the payments. This account is also called a transaction account. Let's look at a simple example of moving and accounting of investment money in a company. The owner has paid to the bank account the share capital of €200,000. The increase in assets, money, is recorded on the debit side, and the capital increase is recorded on the demand side because the recording is in balance and the assets and liabilities have been increased. Receivables claims. An important accounting category is receivables, meaning that someone owes money, services, or products. There are receivables from customers, suppliers, employees, financiers, participants in profit, the state. They may be short-term or long-term. SAS 5 is used in the bookkeeping, accounting and disclosing of short-term and long-term operating receivables. Handles. Classification of receivables. Recognition and elimination of receivables. Initial accounting measurement of receivables. Revaluation of receivables. Disclosure of receivables. It does not process active, capitalized, accruals. It is mainly related to Slovene Accounting Standard, SRS, 15, 17 and 20. Claims on the property and other relationships are designed to require a person to pay a debt from a particular person, or, in the case of advances given, the supply of certain objects or the performance of a service. In any case, except in the case of advances granted, the contractual right of one party to receive the money needs to be matched with the corresponding obligation of the other party to fulfill the obligation. Financial assets are not considered as operating receivables, but only as those related to the financial revenues deriving from them. Financial assets other than operating receivables are dealt with in SAS 3 investments. Deferred costs and accrued revenues are classified as operating receivables only in the broad sense and are not subject to this standard. Classification of receivables according to their type. Short-term receivables can be divided into receivables from customers, employees' claims, government receivables, for example excess payment of VAT, and other short-term receivables. Here is a basic business example recorded in the T account, which is showing the receivables from the buyer for the sale of goods from the inventory. The company sells goods in stock in the net amount of €100,000, VAT 22% is also charged. The case simply illustrates the net value of goods sold, €100,000, which is shown in the balance sheet as an increase in sales revenue, together with a VAT obligation at the general rate, €22,000. On the other hand, a receivable from a buyer of €122,000 is established. Inventories of products, services and merchandise are capitalized by different methods that depend on the direction of the company and on the nature of production. Slovenian Accounting Standards is familiar with three methods. The cost of valuation with production costs, which is used by most companies in the case of steady production and even sales, and in the value of inventories, charges the following costs: direct costs of material, labor and services and depreciation, while adding an adequate part of general production costs. The method of valuation with a narrowed price is a method that captures more value in the inventory than the first one, and it is used when the production is uniform and the sale fluctuates in periods. In addition to the costs of the above method, we also include general procurement, administration and sales costs. The variable cost valuation method is applicable to those companies where the volume of production fluctuates, while sales are more or less constant, and include the following categories of costs: direct costs of material, labor, services and depreciation, and a variable part of general production costs. Services can also be accounted for in stock by the costs incurred upon their production. The merchandise is placed in stock by purchase or at the selling price, but also at the price with VAT included. Of course, the difference in price and VAT should then be kept as an expenditure in certain accounts. The next category is the stock of raw materials, and small inventory and packaging. These components are purchased in stock and used through production to produce the product, which is then sold. Each company decides by which method the material it holds in stock will be used. A specific price can be changed for each delivery. Whether a company chooses the FIFO method, the weighted average price method or the floating average price, should be decided according to the type of production. SAS 4 is entirely devoted to the rules governing the management, valuation and inventories of supplies of goods, materials, products, semi-products and other assets. Most of the stocks are held by companies with activities such as production, catering, trade, service, etc. The inventory includes quantities in the warehouse, finishing, processing, as well as those held by companies in, for example, retail store. Companies are required to provide a transparent inventory record with material bookkeeping, trade records, etc. A stock of material is also considered a small inventory with a useful life of up to 1 year or more if its individual purchase price does not exceed €500. Inventories of materials and goods are valued at the purchase price, consisting of the purchase price, including discounts, import and other non-refundable charges and direct purchase costs, transport. In order to reduce volumes, mainly due to fiscal legislation, smaller companies generally use the FIFO method, while small inventory is usually transferred to costs immediately within the same tax year. The value of inventories used, material, is treated as a cost, while the value of inventories sold, goods, is treated as operating expense. Both categories decrease the company's profit or loss, decrease in profit. The obligation is the present obligation of the entrepreneur, resulting from past events for whose settlement the outflow of resources is expected. They are classified as short-term and long-term. In order for the obligation to be classified as short-term, it must meet the following criteria. It is expected to be settled in a regular business cycle. It is due to be settled within 12 months after the balance sheet date. It is primarily held for trading. The entrepreneur has no unconditional right to postpone the obligation settlement for at least 12 months after the balance sheet date. When obligations do not meet the above criteria, we classify them as long-term obligations. The example of recording of long-term obligations. T accounts show simple example how to record long-term liabilities for borrowing cash from another company. The entrepreneur ABC has received a loan from XY company in the amount of €250,000. For a maturity of 5 years, the funds have been credited to the GIRO account. This simple illustration of posting shows an increase in long-term liabilities to the bank for loan on the liabilities side, as well as an increase in cash on the asset side of the balance sheet. Capital represents a financial resource or source that is available for productive and profitable use. Equity may be contributed by the owner of the enterprise as an own contribution, equity, or may be obtained in the form of a loan, debt capital. In both cases, capital is used for the purpose of generating assets, which we call investment. Capital is not only an initial investment but can be generated and increased through successful business and management. The well-known writer and economist Adam Smith, in his book Wealth of Nations, defined capital as part of a human asset that he expects to provide him with income. As already mentioned, equity may be equity or debt, depending on who has contributed funds to the company and under what conditions. At the same time, capital can also be divided according to the legal form of the company, namely, share capital, capital with shares, capital role. Capital does not mean exclusively money, but can also represent other material assets. From an accounting point of view, capital represents an obligation to the owner. Slovenian Accounting Standard 8 defines the company's capital as its obligation to the owners who are due for payment if the company ceases to operate. It is defined by the amounts invested by the owners and the amounts that have arisen in the course of business, profits, and belong to the owners. It is reduced by loss in operations, repurchased treasury shares and own business shares and withdrawals, payments. The amount of capital is a sign of the financial stability and power of an individual, an organization or a nation. More capital also means greater stability and strength and the ability to generate profits. SAS 8 applies to bookkeeping, accounting and disclosure of capital as a liability to owners. Handles. The classification of capital, recognition and elimination of capital gains, initial accounting measurement of capital, capital revaluation, disclosure of capital. It is primarily related to Slovene accounting standards, SRS, from 1 to 7, from 9 to 11 and 20. Payout a profit from a limited liable company. The determination of distributable profit and its allocation constitute one of the fundamental rights of shareholders acquired on the basis of the initial contribution to the company. In addition to shareholders, third parties may also be involved in the distribution of profits. The contribution details the process of deciding on the realized profit of the company, the tax consequences for the company that pays the profit and the method of taxing the recipient. Regarding the distribution of profits between members of a limited liability company, the Companies Act, ZGD 1, states, shareholders have the right to decide on the use of accumulated profit, decision at the general meeting and adoption of the relevant resolution. Shareholders have a right to a share in the accumulated profit, as established in the annual balance sheet, unless otherwise provided by the social contract. Profits are generally divided in proportion to the amount of business interests, unless otherwise provided by the social contract. An example of recording in the general ledger. The profit in the financial year has been determined by the profit and loss account in the amount of €40,000 and has been recorded in the account 932 profit in the financial year, And according to the shareholders' meeting decision, the profit is distributed as follows. Member X €10,000. Member Y €15,000. Member Z €15,000. Company may retain a positive business result, profit, in the balance sheet and transfer it to the subsequent accounting period. The owners of the company, by means of the resolution on the distribution of profits, determine the method and the amount of each share. The example shows that the profit was distributed proportionally, according to the amount of the business share. Good accounting practices, PSR, are a complement to the Slovenian accounting standards and deal with the rules and methods of operations in individual accounting areas, such as bookkeeping documents and books, bookkeeping, accounting calculation, accounting supervision, accounting analysis, accounting information, consolidation. Therefore, the PSR is the recommended professional basis upon which internal reporting in the organization should be based, and in particular, the regulation of the field of bookkeeping documents. Every bookkeeper must continuously improve his skills and knowledge, stick to the legal regulations and the ethics code. It is good to subscribe to relevant publications so that the person is always informed on changes to legislation. On the other hand, the business organization management is interested in the financial position of the company and its profitability. For this reason, the management aims to get the financial statements as often and as quickly as possible so it can take actions to repair areas with poor results. Investors will be particularly interested in the annual financial statements because these are the reports used by decision makers outside the company. For example, if creditors see the balance at the end of the year as strong, they will be more willing to give credit to the company than if the financial position of the company is weak.